How did the Great Depression lead to the creation of the SEC? Have you ever wondered how a major economic crisis can change the way we invest and protect our money? The Great Depression, which began with the stock market crash in 1929, revealed serious flaws in the financial system of the United States. This period was marked by rampant fraud, a lack of transparency, and manipulative trading practices that left many investors feeling betrayed and confused. As the economy crumbled, it became clear that something had to change. The crash wiped out billions of dollars in wealth and shattered the confidence of everyday investors. People were afraid to invest their money, fearing they would lose it all again. The need for federal oversight became apparent as a way to restore trust in the financial markets. In response to this crisis, the United States government passed the Securities Exchange Act of 1934. This act led to the establishment of the Securities and Exchange Commission, an independent federal agency designed to regulate the securities markets. The main goal of the Securities and Exchange Commission was to enforce laws that required companies to provide full and fair disclosure of their financial information. This meant that companies had to be honest about their financial health, which would help protect investors from fraud. Before the creation of the Securities and Exchange Commission, regulations were scattered and ineffective. Different states had their own laws, which made it easy for dishonest practices to slip through the cracks. The Securities and Exchange Commission introduced uniform national standards, requiring all publicly traded companies to register and regularly disclose accurate financial data. This transparency was essential for investors to make informed decisions and helped reduce the risk of market manipulation. Joseph P. Kennedy was appointed as the first chairman of the Securities and Exchange Commission. He faced the daunting task of encouraging capital investment during a time when many investors had pulled out of the market. Kennedy worked closely with industrialists and financiers to streamline regulations while ensuring that investors were protected. His efforts aimed to bring capital back into the markets, which was vital for economic growth. The formation of the Securities and Exchange Commission marked a turning point in the development of financial markets under capitalism. It showed that effective regulation could work alongside capitalist principles. By ensuring that markets operated fairly and transparently, the Securities and Exchange Commission helped restore investor confidence and market integrity. In practical terms, the establishment of the Securities and Exchange Commission played a key role in stabilizing financial markets and encouraging investment. This contributed to the broader recovery of the United States economy after the Great Depression. The Securities and Exchange Commission set a precedent for ongoing regulatory oversight, adapting to changing market conditions to ensure that capitalism's mechanisms for raising and allocating capital function more reliably. The creation of the Securities and Exchange Commission was a direct response to the failures exposed by the Great Depression. It laid the groundwork for a more secure and trustworthy financial system, which remains essential for investors today.